Happy Monday, everybody. I hope you had a great weekend. Today is Monday, July 10, 2023, and this is your special on location Monday market update. Let's review last week as choppy as it was, and let's preview the week ahead. Last week, Monday was a short day with markets only open until 1 p.m. Eastern. Stocks did open near unchanged and right about a sensitive number of 4450 on the S&P. Eco data was on the list to be watched. ISM manufacturing at 10 a.m. But anyone who tells you that someone was watching that is probably wrong. The algos ran the show, and even they were on vacation mode. The S&P moved higher midday, closed up less than 1/4%. Overall, there was a start to the second half about how we ended the first half. A few stocks leading, and then there the rest. The Dow was nearly flat. S&P, as I said, was up less than 1/4%, and NASDAQ was up about 1/4%. Tuesday was, of course, the holiday, and the markets were closed. So on to Wednesday and how things panned out. Markets gapped lower after the holiday. Hangover? Not sure, but negative eco data was more likely to blame. The Chinese recovery is looking tougher and tougher to see in the numbers as days go by. And this was another one. Euro and Chinese CPI took some bloom off the markets, and nothing much else as the markets waited to see the FOMC minutes from last month. Recall that this was the month that Powell came out and said that although the votes were unanimous, there was some dissent. And as I told you last week, this would be a non-event, and it was. Nothing new came out of the report. Markets never even got steam either way. And by the end of the day, the Dow was down 1/3%, S&P was down about 1/4%, and the NASDAQ was also down about 1/4%. The markets prepped for the end of the week deluge of labor data. Markets woke up with the first real surprise of Q3 on Thursday as jobs and eco data caused its own fireworks. ADP private payrolls is always hard to gauge, but nearly twice the expectation at close to 500,000 jobs, the highest since July of 2022. That had the 10-year Treasury spike, and that was not good for stocks. Jobless claims were just about in line, about 250,000, and JOLTS came in below 10 million again. Overall, stocks opened lower and proceeded to sell off. All averages down more than 1% at one point by the end of the day. The Dow was down just over 1%. S&P and NASDAQ were both down about 0.75%. All was lined up for earnings. Nope, not yet. Yes, first Friday of the month, non-farm payrolls. After Thursday's numbers, expectations were adjusted, but all eyes were on the jobs. Fireworks Friday? Not really. Futures did fall a bit on the non-farm payrolls, but it was not the numbers, but it was the uptick in wages that were in the numbers. Regardless, positive Fed commentary kept markets from going too far from flatline, and the markets ended as a bit of a dud. Dow was down about 0.5%, S&P down about 1/4%, and the NASDAQ was down just under 1/4%. On the week, the Dow was down just under 2%, the worst week since March. S&P down a bit over 1%, and the NASDAQ down just under 1%. A quick note on the worst week comments. Last week, I read something about the worst week since May. Well, let's keep things in perspective. The only one that worst week since May means anything to are the short-term trader. It was really not only 2 months ago. Really? Remember, traders have to have something to do every day. Long-term investors do not, and in most cases, we should not react daily to the newswires. Reminder that we will stay focused on your long-term goals, and as one of you and I discussed late last week, when I check my accounts, I look for how I'm doing on getting to a level that we've agreed on and that we can retire on, and do what we want to do, when we want to do it, and how we want to do it. That is the goal. Earnings season is coming soon, starting July 14th. This coming Friday as bank earnings start to roll out. This is what I've been talking to you about. I do think that earnings will start to take some of the oxygen from the Fed. Valuations are based here. Yes, the calculations bring in the Fed and interest rates too, but overall, this is where things come from. This past earnings season actually got better as it went along, and it ended up with only a slight decrease in year-over-year earnings. This coming quarter, FactSet estimates call for a 7% year-over-year decline, but be sure that's not the whole story. As you know, the headlines are not always the right direction. Energy estimates are down 48%, material estimates are down 31%, and healthcare down 17%. Communications and services are the other way. Estimates are up 13%. Consumer discretionary estimates are up 27% year-over-year. If things hold in well and we get some upside surprises as well as earnings adjustments up and not down, we can make some real impact on the valuations. This is why this will be the biggest news. And possibly if the Fed steals the thunder, this may bring the best opportunity. While we wait for earnings, we have a very full week of eco data and Fed heads. The biggest eco data will come Wednesday and Thursday when we get CPI and PPI. Thursday will bring the weekly jobs data, and Friday will bring the University of Michigan survey info. But make no mistake about it, as much as I told you that earnings will be the big market mover going forward, we have to get more supporting data on the economy. So far, we have support of the growth is slowing, but not falling off a cliff. Inflation is slowing, and that supports the idea that the Fed will only have to raise 1 or 2 more times. Once we have more to build on that foundation, we'll be focused on earnings and valuations for those Fed heads. This week we'll hear from Barr, Daly, Mester, Bostic, and that's just today. Then Barkin, Kashkari, and Waller, they'll still be heard from before the end of the week. Earnings will be the soup du jour, so watch for a few big names, but even they will not be watched too closely until Friday. We'll get Pepsi and Delta among others before then, and those will be telling, but the big ones are Friday. We'll get JP Morgan, Citi, Wells Fargo, and BlackRock among others. So as you can see, as Janet Yellen departs China, we'll see how that plays out, and there's a lot on the domestic and global eco front. Keep nimble, but remember, we're focused on the goals, and most of them are beyond this week. Come back on Friday and for some more planning ideas, and stay in touch. Have a great week.